Hello and welcome to Wealthdepo's investment update for September. US President Trump has regularly stated that he is prepared to extend protectionist measures against all Chinese imports. We can be sure that whatever the extent of such measures that do eventually come to pass, that there will be a proportionate response from the Chinese. Increasingly, there is good reason to believe that this is not a matter that will be resolved in the short term, as an understanding of the politics at play in both countries reveals. To this point, the equity markets in each country have actually behaved differently. In the United States, the main benchmark index is regularly setting fresh highs, though much of the strength is due to the corporate tax cuts passed earlier this year than any positive reaction to the trade war specifically. Some observers are starting to question for how much longer that boost will be supportive, as the strong performance of US companies around the announcement of the tax cuts has turned around of late. In China, and indeed the broader range of emerging markets, there's been a weakness in share prices, and in large part this has been in response to persistent strength in the US dollar. It should be noted, however, that the real problems have occurred outside the Asia-Pacific region in countries like Argentina, Turkey, and Venezuela. We are monitoring developments very closely, but continue to persist with our exposures to the international equity markets. Australian companies have just concluded a generally positive reporting season, with earnings growth beating expectations. The best performing sectors were healthcare, technology, food and beverage, accompanied by some surprising resilience in the retail, insurance, and media sectors. Of the larger sectors, it should come as no surprise that the banks were in line with only modest expectations. However, the resources sector continues to benefit from strong commodity prices. Listed property has been a particularly strong asset class in recent months and continues to move in a predictable manner relative to changes in government bond yields. The asset class has appreciated in price terms by better than 15% since February and nearly 18% when income is included to report total return. Some consideration has been given for trimming exposure in this asset class. However, on balance, we expect bond yields to stay low and perhaps fall further, which would be suggestive of further gains to come. We are monitoring developments and comfortable with current asset allocation exposures in international equities, and there remains a wide variety of potential outcomes to the dispute between the United States and China, with spillover effects to other countries around the world. Our judgment continues to be that it would be imprudent to reposition portfolios ahead of greater clarity about the eventual outcomes. Until next time, take care and have a wonderful day.